Welcome to this deep dive. We've got a massive stack of material in front of us
Oh,
today.
yeah. Q2 earnings transcripts, analyst notes, AWS blueprints, you name it.
Right. And our mission today for you listening is to unpack what might honestly be the most fascinating, contradictory corporate earnings report of the decade. We are looking at Amazon's Q2 2026 financial crossroads.
It really is a masterclass in financial cognitive dissonance.
Exactly. Because when you look at these numbers, on one hand, you have this historic milestone. I mean, for the very first time, Amazon crossed $200 billion in a single quarter.
Which should,
$200.61 billion in revenue, to be exact. That's up 20% year over year.
right. I mean, top line velocity at that scale is almost difficult to comprehend.
Yeah.
And the bottom line initially looks, just as robust.
Oh, totally.
Earnings per share came in at $5.75, though we do need to immediately strip out the $50 billion pre-tax gain from their Anthropic investment.
Yeah, that skews things heavily.
It does. But even adjusting for that, the EPS is $1.95, which cleanly beats the $1.82 Street estimate. And Wall Street reacted exactly how you'd expect, right? Setting the stock up like 8 to 9% in after-hours trading.
Which brings us to the plot twist. Because if you peel back the income statement and look at the actual cash flow, my inner financial analyst starts waving a giant red flag here.
Oh, I know where you're going with this.
Yeah. Trailing 12-month free cash flow has turned negative.
Yep.
We are sitting at negative $7.6 billion. So you really have to ask yourself, how does a $2.58 trillion company
Right.
generate a massive $161.4 billion in operating cash flow from its actual business,
A staggering amount of cash.
but still end up bleeding free cash flow?
Well, the cash isn't just evaporating, right? It's being converted into concrete, copper, and silicon at an unprecedented rate.
Mm-hmm.
We're looking at $169 billion in net capex over the trailing 12 months. That outpaces their entire operating cash flow.
Which is wild.
It is. And to traditional value investors, negative FCF is usually, the sirens going off. But the market isn't punishing them for it because institutional investors are interpreting this not as a structural deficit, but as the beginning of a massive AI supercycle.
They're basically betting it's a feature, not a bug.
Exactly.
But let's follow that money, because to understand why they are incinerating cash today, you have to look at the mechanics of what they're rushing to build.
Right. You got to look at the cloud.
Yeah. AWS revenue surged 37% year over year to $42.23 billion for the quarter.
It's massive.
Annualized, that's a $169 billion run rate just for the cloud division, and it's their fastest growth rate since late 2021.
Top-line growth is one thing, but the margin expansion is the actual story here, I think.
Okay, break that down.
So operating income for AWS leaped 64% to $16.6 billion. That pushes operating margins to 39.4%. Yeah, up from 32.9% a year ago. Mechanically, achieving a nearly 40% margin on physical infrastructure, that requires phenomenal utilization rates. You just don't get there by renting out basic compute anymore.
Right, you get there through the AI catalysts, the massive enterprise adoption of Bedrock, which is their generative AI platform, and that really deep structural integration with Anthropic.
Absolutely.
Analysts are actually modeling that the Anthropic relationship alone contributed over $1.5 billion in sequential AWS revenue growth.
Yeah, because Bedrock allows enterprise clients to build proprietary apps using foundational models, but without having to manage the underlying infrastructure.
And Amazon takes a massive cut of that consumption.
Exactly.
Mm.
But the true driver of that 39.4% margin expansion, it's actually sitting one layer deeper in the tech stack. It's the transition to custom silicon.
The in-house chips.
Yeah. Trainium and Inferentia chips just crossed a $25 billion annualized run rate.
The velocity of that hardware adoption is terrifying. I mean, it was at a $20 billion run rate just 3 months prior.
They added $5 billion in 90 days.
But wait, let me push back here. NVIDIA practically owns the AI developer ecosystem with their CUDA software, right?
They do, yeah.
So why on earth would a massive enterprise rewrite their entire software stack and disrupt their workflows just to save a few bucks on Amazon's in-house chips?
Well, it's not just a few bucks. It really comes down to the brutal realities of data center physics and the total cost of ownership, TCO.
Okay.
When an enterprise is running inference-generating responses from an AI model 24/7, the cost isn't just the chip itself. It's the power grid, the the cooling systems, the physical footprint in the server rack.
Right, the whole ecosystem.
Exactly. And Amazon has designed Trainium and Inferentia specifically for the architecture of their own data centers.
Yeah.
Because they control the power delivery and the cooling topology, these custom chips are delivering 30% better price performance than comparable off-the-shelf GPUs.
So they are fundamentally changing the OpEx equation for the customer.
And altering the strategic dependency, which is huge.
Oh, wow.
Well, if you are an enterprise spending hundreds of millions on AI compute, you want to avoid being held hostage by NVIDIA's pricing power
All right.
and their supply chain bottlenecks.
Yeah, that makes sense.
So by adopting Amazon Silicon, you drastically lower your TCO, but the trade-off is intense lock-in.
Ah, there it is.
Yeah. Once a client optimizes their machine learning models to run on Trainium architectures, migrating away from AWS becomes a logistical nightmare.
The switching costs become an impenetrable moat.
Exactly.
And the market is clearly buying in. Trainium 2 chips are entirely sold out.
Gone.
Trainium 3 is shipping now with another, 30 to 40% performance bump?
Yep.
And Trainium 4 is already largely reserved 18 months before broad availability.
It's unprecedented demand.
But let's look at the sheer cost of digging that silicon moat, because chips and data centers are notoriously capital intensive. If AWS is printing money at a nearly 40% operating margin, where exactly is that $161.4 billion in operating cash flow going?
It's going directly into the ground, basically.
Yeah.
Land acquisition, laying high-voltage power lines, pouring concrete, and standing up these massive server farms globally.
Right.
Andy Jassy just raised 2026 CapEx guidance from $200 billion to approximately $220 billion.
Driven heavily by memory chip inflation, from what I read, and just the sheer labor and material costs of construction.
Oh, definitely.
And to fund this insatiable appetite for infrastructure, Amazon just executed a massive $25 billion bond sale in early July. And this is what breaks my brain a bit.
The debt.
Yeah. You have a company sitting on roughly $57.4 billion in net cash, excluding leases. Why take on $25 billion in debt in a relatively high interest rate environment?
Because of the scale and speed of the capital required. I mean, deploying $220 billion in a single year strains even Amazon's working capital dynamics.
That's fair.
Jassy's defense of this massive spend centers on what he calls the timing gap thesis. It's an accounting reality that heavily distorts the cash flow optics for you and me looking at the spreadsheet.
So it's kind of like paying cash up front to build a 30-story apartment high-rise. For the 2 years of construction, your bank account is draining rapidly, and on paper, you look completely broke.
Yes.
But the day the building opens, you have 30 years of high-margin rent coming in without ever having to pour that concrete again.
That is the exact mechanism at play with the physical data centers. The land, the shell, the power grid, those require massive capital outlays, roughly 2 years before a single server can be monetized.
Right.
But they're 30-year assets. Now, the internal components operate on a tighter cycle.
The servers themselves.
Exactly. The servers and networking equipment are purchased just a few months before going online. And Jassy noted that those servers take a little under 3 years to break even on a cash basis. But they have a useful life of at least 5 to 6 years.
So for years 4, 5, and 6, that server is pure profit generation.
Provided the capacity is actually utilized.
Right. That's the big caveat.
Yeah. But Jassy pointed out that most of their AI capacity is being contracted right now for terms of 5 years or longer. So they are matching the useful life of the asset with guaranteed revenue contracts.
The math works perfectly on a spreadsheet if the customers stay.
True.
But you are still taking on massive balance sheet risk. I mean, think about it. They are spending a quarter of their projected revenue on infrastructure.
That's a huge bet.
It's like funding the equivalent of the entire Apollo space program in a single year, just on servers and concrete. If you build the high-rise and the tenants don't show up, or they find a cheaper building down the street, that 30-year asset becomes a 30-year liability.
For sure.
You still have the maintenance, the property taxes, the energy contracts. It's an enormous gamble on sustained utilization.
The risk of overbuilding is very real. But they aren't funding this purely with debt or hope.
Thank goodness.
Right. To sustain an Apollo program level of spending without completely crushing the balance sheet or, heavily diluting shareholders, Amazon relies on the parts of the conglomerate that the market often overlooks because they just aren't as flashy as generative AI.
You're talking about the high-margin supporting engines.
Exactly.
If the cloud build-out is consuming every dollar of operating cash, we have to look at what's actually funding the core business. Advertising revenue hit $19.8 billion in Q2, up 26% year over year.
That's a massive jump.
It is. We saw a boost from the integration of ads into Prime Video, and of course, shifting Prime Day into June helped. But the killer metric here for you listeners tracking profitability advertising carries roughly 90% gross margins.
90%. Because the infrastructure to deliver that ad already exists.
Exactly.
A cost of showing a sponsored product placement to a shopper who is already navigating Amazon.com is virtually zero. You aren't paying for content acquisition or user acquisition the way traditional media networks do.
And that ad engine sits entirely on top of the retail and third-party marketplaces.
Which is doing great too.
Yeah, online store sales rose 15% to $70.4 billion, while the third-party seller services rose 16% to $46.8 billion. Independent sellers now account for 61% of all units sold.
Looking at that 3P seller data, retail operates as the ultimate Trojan horse here.
How so?
On its own, retail is a brutally tough, capital-intensive business. I mean, they are operating the retail side at a razor-thin 6.9% operating margin.
Ouch.
Yeah, that's standard distribution-style economics.
They basically operate at 6% just to get the shoppers in the door, capture the intent data, and sell the 90% margin ads.
You nailed it. The intent data is the key. They don't have to guess what a consumer might want based on, like, a passive social media scroll or demographic assumptions.
Right, they are guessing.
No, they observe direct purchase intent. They know exactly what you search for, what you put in your cart, and what you abandon. That data is the most valuable commodity to an advertiser.
They're the holy grail.
Yeah, so the low-margin retail business feeds the high-margin ad business. And those billions in high-margin cash flow are what's actually buying the concrete, the copper, and the custom silicon for AWS.
So we have three distinct engines, right? AWS, advertising, and retail functioning as this closed-loop ecosystem.
A flywheel.
Yeah, the retail scale drives the ad margins, which funds the AWS infrastructure, which in turn powers the AI that optimizes the retail logistics and ad targeting.
It's a beautiful machine.
It really is. But we still have a $220 billion CapEx bill hovering overhead.
We do.
How do we value a stock currently trading at a premium 33.5x trailing price-to-earnings multiple under these conditions? Because if I take the bear case here, 33.5 times earnings means perfection is already priced in.
Oh, absolutely. You are priced for flawless execution. Any operational misstep triggers a massive multiple contraction.
Right. What if enterprise clients pause their AI spending because they aren't seeing the ROI on their own generative AI projects yet?
Which is a real fear in the market right now.
Yeah. We're assuming these 5-year contracts hold up, but what if memory costs continue to inflate, pushing that CapEx bill to $250 billion? Or look at the competition.
Azure and Google.
Exactly. Microsoft Azure and Google Cloud are incredibly well-funded hyperscalers. What if they initiate a brutal price war on AI inference just to maintain market share?
Oh, it hurt.
It causes severe margin compression stretching deep into 2027. If AWS growth decelerates from 37% down to, say, the mid-teens, the market will not support a 33x multiple.
No way.
The valuation resets, potentially dragging the stock down toward $175 per share scenario. When you are spending $220 billion on a single thesis, the downside risk is catastrophic.
The margin compression fear is totally valid, particularly if the hyperscalers decide to race to the bottom on compute pricing. But the bull case argues that Amazon's custom silicon protects them from that exact price war.
Because of the lock-in.
Right. If enterprise AI capacity fills rapidly, and the fact that Trainium 4 is reserved 18 months out suggests the demand is inelastic right now, then the custom chips successfully lower unit economics, expanding AWS margins even further, regardless of what Azure does with standard NVIDIA hardware.
But that relies heavily on the CapEx cycle actually plateauing at some point.
It does. The upside scenario requires the infrastructure build-out to normalize by, say, 2027 or 2028.
Okay.
Once they get over this initial generative AI hump, the capital expenditure flattens out. Meanwhile, operating cash flow has continued to compound. So when CapEx flattens and operating cash flow rises, free cash flow sharply reaccelerates.
The inflection point.
Yes. We go from negative $7.6 billion back into massive tens of billions of dollars in profitability. That cash flow explosion pushes the stock toward the $360 upside scenario.
It really challenges you to weigh the evidence on a macroeconomic level. Are we looking at the peak of a bloated AI hardware cycle driven by FOMO, where everyone is overbuilding capacity that just won't be utilized? Or are we standing on the ground floor of a 30-year infrastructure monopoly And Jassy is just securing the real estate before anyone else can.
It hinges entirely on whether you believe the timing gap is a temporary construction phase or a permanent capital drain required to stay competitive in AI.
So, to summarize what we've unpacked today for you listening, the core tension of Amazon in 2026 is that the company has completely transformed.
It's true.
It is no longer just a retailer. It is a high-margin services conglomerate driven by AWS compute, targeted advertising, and third-party seller fees.
Yep.
But despite having the strongest operating economics in its history, they are deliberately sacrificing near-term liquidity, taking on debt, and running negative free cash flow for an unprecedented AI infrastructure land grab.
They are structurally choosing future systemic dominance over present-day balance sheet aesthetics.
There's an endpoint to this strategy that none of the Wall Street notes really address today, and I want to leave you with this thought.
Wait on me.
Think about it. If this $220 billion bet actually pays off, and their in-house Trainium and Inferentia chips become the default standard for developers globally simply because of Amazon's massive scale and availability.
Which is very possible.
Does Amazon stop being just a cloud provider and a retailer?
Well, if you control the custom silicon, the physical data centers that house them, the cloud ecosystem that runs the software, and the consumer retail platform that generates the data to train the next generation of models.
You effectively become the underlying utility grid for global artificial intelligence.
Wow. Yeah.
If one single company controls the chips, the power grids, the software ecosystem, and the global consumer platform, they aren't just participating in the AI economy anymore.
They are the economy.
Exactly. It's the difference between building a factory and owning the electric grid that powers every factory on Earth.
When you frame it as a utility grid, the $220 billion price tag almost seems like a bargain for that level of global infrastructure control.
And suddenly, that initial cash flow statement doesn't look like a financial warning sign at all. It looks like the blueprint for a corporate structure we've never actually seen before.
It's going to be fascinating to watch play out.
It really is. Thank you for joining us on this deep dive into Amazon's 2026 financial crossroads. We invite you to keep exploring the sources and the data on your own. Keep questioning the mechanics behind the headlines, and we'll see you on the next one.